Why do some of the wealthiest institutions in the world still trust paper promises instead of taking physical delivery of their gold? On the TFTC podcast, Peruvian Bull, a renowned macro analyst known for his viral debt cycle threads and prescient market predictions, breaks down the fundamental flaws in the gold market. In today's discussion, we'll examine three central points: how gold's physical nature forces centralization, why modern gold markets are built on increasingly shaky promises, and how Bitcoin's architecture provides a revolutionary solution to these age-old problems. The insights shared in our final segment reveal why Bitcoin's design isn't just an improvement on gold, it's a complete reimagining of sound money. But first, let's understand why gold's physical nature creates unavoidable problems.
The problem with that, again, is that gold has this settlement and centralization issue where it's impossible, obviously, for microtransactions to be conducted in gold. So it gets centralized and stored. And it's just like this is just a mechanistic, like physical law that is impeding gold. And then once you do that, once you centralize the gold and issue paper promises to transact in it, you get this issue of, okay, well, do they really have the gold? Can we trust the auditor, even if they are audited? And then some banks, obviously like the BOE, has been refusing audits, and the Fed has famously refused audits. So no one really knows if they actually have the gold or if they're just holding gold credit with other institutions that also say they have the gold. So this issue is systemic to the market and it's structural. And even if we reset the system today back to 100% gold reserves, it would eventually start to perpetuate itself again. It would eventually start to see more paper gold trading than physical.
Let me break this down because it's a fascinating explanation of why gold, despite being the historical king of sound money, has some serious problems built into its DNA. What Peruvian Bull is getting at here perfectly illustrates our first key argument. Gold's physical nature forces centralization. Think about it. You can't exactly carry gold bars around to buy coffee or groceries. This means it has to be stored somewhere, and that's where things start to get messy. This physical limitation isn't just an inconvenience. It's a fundamental flaw that creates an unavoidable centralization problem. When you centralize anything valuable, you create points of failure and trust issues. Banks and institutions end up holding the gold, and they start issuing paper promises saying, "Trust us, we have the gold." Sound familiar? It's exactly what happened with traditional banking. The Federal Reserve and Bank of England won't even let anyone audit their gold holdings. That should raise some eyebrows. What's really compelling about Peruvian Bull's analysis is how he demonstrates that even if we tried to reset the whole system and start fresh with 100% gold backing, we'd end up right back where we started because of this fundamental flaw in gold's physical nature. This is exactly why Bitcoin's digital nature and ability to be self-custodied is so revolutionary. It solves this exact problem by removing the need for physical storage and centralized custodians altogether. We've just seen how gold's physical nature creates an unavoidable centralization problem, but stick around because next we'll see how these trust issues are playing out in real time in today's gold markets, exposing an even deeper problem with the entire system. And trust me, you won't want to miss our final segment where we explore how Bitcoin provides a groundbreaking solution to these age-old problems.
So there's a couple different theories. The first one is the trade war and the tariffs. It seems that there's fear that the current administration will submit significant tariffs to gold. And that has caused these bullion bank traders, especially in New York, to rush to take physical delivery of their holdings in London. Because the problem is a lot of these institutions actually hold their physical gold with London-based custodians. So, for example, the GLD ETF, which holds, well over 1 million ounces of gold, has all of their holdings in HSBC, all of their gold holdings custodied by HSBC, and all of those are in London. And so if they want to front run, right, some sort of tariff threat of moving gold from one country to the next will have 20% fee attached to it, then they have to move the gold right now.
This is a perfect real-world example that builds on our previous point and demonstrates our second key argument about the trust issues in gold markets. We're seeing a real-time scramble in the gold markets because of potential tariffs, and it's exposing the whole house of cards. When Peruvian Bull mentions the GLD ETF having their gold held by HSBC in London, he's highlighting a crucial point. Most people who think they own gold actually just own a promise from someone else who says they have gold. It's like a game of musical chairs, but with precious metals. These institutions are rushing to get their hands on physical gold because they're worried about new tariffs making it more expensive to move gold between countries. This is creating a domino effect where everyone's trying to verify that the gold they think they own actually exists. What makes this particularly significant is how it demonstrates the fragility of the entire gold market structure. When you need a massive bank like HSBC to hold your gold for you, you're introducing exactly the kind of third-party risk that sound money is supposed to eliminate. This verification and trust problem isn't just theoretical. We're watching it unfold in real time as institutions scramble to secure their physical gold.
Sup, freaks? This rip of TFTC was brought to you by our good friends at BitKey. BitKey makes Bitcoin easy to use and hard to lose. It's the easiest 0 to 1 step, your first step to self-custody. If you have friends and family on the exchanges who haven't moved it off, tell them to pick up a BitKey. Go to bitkey.world, use the key TFTC20 at checkout for 20% off your order. That's bitkey.world, code TFTC20.
We've now seen how gold's physical nature forces centralization and how that centralization creates serious trust issues in modern markets. Stay tuned for our final segment where we'll explore how these structural issues create a self-perpetuating cycle that keeps making the problem worse, and most importantly, why Bitcoin's architecture offers the only viable solution to these fundamental problems.
We start to see more and more promises. Well, taking delivery is difficult, right? At the COMEX, it's 100-ounce bars. And so if you're a retail investor, that's $280,000 or whatever. Like, you're not going to take that physical 100-ounce bar in delivery. So you just settle it for cash. And you would just see the system perpetuate itself again and explode to the current, 10 to 1 paper to gold leverage ratio. And it would just happen again. And, there's also been regulatory changes, right? We saw change to the NSFR, which is the net stable funding ratio with Basel III in 2021 that allowed gold, but only physically held and unallocated gold holdings to be counted as 0% haircut assets under Basel. So basically allowing them to be treated as like a reserve asset, just like treasuries or, MBS or whatever other high quality bond.
This final segment really drives home our third key argument about how Bitcoin solves gold's structural issues through its digital nature and decentralized verification. When Peruvian Bull points out that COMEX delivery requires 100-ounce bars worth around $280,000, he's highlighting how the system naturally pushes regular investors away from taking physical delivery. Think about it. If you can't actually take possession of the gold you supposedly own, what do you really own? You're forced to accept cash settlement instead, which just perpetuates this cycle of paper promises. And that 10 to 1 leverage ratio he mentions, that means for every ounce of physical gold, there are 10 paper claims on it. It's like selling the same house to 10 different people. It works fine until everyone shows up wanting to move in. The regulatory change he mentions about Basel III is particularly telling. Banks can now count physical gold as a Tier 1 asset, basically treating it like cash or government bonds, but only if they actually have the gold. This is the financial system admitting that all these paper gold products aren't the same as having real gold. But here's where Bitcoin's architectural design proves truly revolutionary. You don't need a massive vault or a trusted third party to hold it. You can verify your ownership instantly on the blockchain, transfer it anywhere in the world without permission, and even buy a cup of coffee with it through the Lightning Network. This completely eliminates the settlement and verification issues that plague the gold market. What makes this so significant is that Bitcoin isn't just an incremental improvement on gold. It's a fundamental reimagining of sound money that solves all three problems we've discussed. While gold remains trapped in a system of physical limitations that force centralization, require trust in intermediaries, and create verification challenges, Bitcoin offers direct verifiable ownership for everyone from major institutions down to individual users. The physical limitations that force gold into centralized storage simply don't exist with Bitcoin. Its digital nature enables true peer-to-peer transactions, its decentralized network eliminates the need for trusted intermediaries, and its transparent blockchain provides instant verification. This isn't just a technical difference. It's a fundamental transformation in how we can own and use sound money. Do you think physical gold is doomed, or does it still have a future? Let me know in the comments. I read every single one. And if you found this breakdown interesting, you'll want to watch our coverage of the $1.5 billion Bybit hack and what it means for Bitcoin custody. Click the video on your screen now. Don't forget to like and subscribe for more daily content. Thanks for watching. Stay humble, stack sats,